Hi, everyone. I'm a job market candidate from Notre Dame, and I'm excited to present my paper about the role of bank concentration for monetary policy pass-through. As well known, the banking sector plays a key function in the transmission and propagation of monetary policy. However, few papers have analyzed how monetary policy pass-through depends on the structure of the banking system. One aspect is bank concentration, which has increased significantly in the US, both at a national and local level. Taking this trend as given, my paper addresses how and whether the rise in bank concentration alters monetary policy transmission. To answer this question, I use granular interest rate data to identify how geographic and bank-specific factors influence pass-through across bank branches. These cross-sectional differences shed light on how changes in bank concentration over time affect transmission. I distinguish between two channels tied to the geographic and bank-specific factors, the market power channel and the capital allocation channel. My paper shows that concentration affects interest rate pass-through and matters for monetary policy effectiveness, financial stability, and distributional effects. Next, I describe the three parts of my paper in detail. Let us start with the empirical findings. Here, I built on a novel, confidential, branch-level dataset from RateWatch. RateWatch regularly surveys US branches and collects interest rate quotes for standardized products. I focus on the one-year adjustable mortgage rate. And to get some sense on the rate variation across branches in time, focus on the bottom left graph representing the interquartile range, median, and federal funds rate. Notice there is significant dispersion, on average more than 100 basis points. Looking closer, I document notable differences across banks within a county and, to a lesser extent, across branches of the same bank institution. I next quantify the importance of geographic and bank-specific factors for explaining the variation in rates and pass-through across branches. Using local projections, I examined the pass-through of monetary policy surprises from Nakamura and Steinson to loan rates, depending on the level of local concentration and bank capitalization. The graphs in the middle present the impulse responses to a monetary shock for a high and low state. The left panel shows a higher pass-through in high concentrated regions on impact and over the next 12 months. Similarly, low bank capitalization leads to a high pass-through in the medium run, shown in the right panel, though the effect is quantitatively smaller. I then use a theoretical model to rationalize the empirical findings and derive the key variables influencing pass-through. So banks choose deposit rates and loan rates to maximize profits, subject to a bank-specific capital constraint and local demand. Loan rate pass-through can then be expressed as a function of two components. First, the markup, or the market power channel, and second, the interaction of the markup with the capital constraint, the capital allocation channel. While in competitive markets with no constraints, bank pass-through is one. Pass-through increases with market power and declines with the capital ratio. Finally, to assess how the rise in bank concentration affects monetary policy transmission to the real economy, I extend a new Keynesian model with a heterogeneous banking sector. As before, banks have monopolistic competition at the local level and size-specific capital ratios. To keep the framework tractable, I consider two types of each, regional and giant banks in high and low concentrated markets. I calibrate the model to the microdata and conduct several counterfactuals, considering structural changes in the banking sector between 1994 and 2019. Contrasting the impulse responses to a monetary policy shock for both environments shows in the figure on the right a higher loan rate pass-through over time and more substantial decline in loans to households, indicating an amplification of the lending cycle. Similarly, output contracts by more, but the effect on inflation is more muted. So one policy implication is a flattening of the Phillips curve, a reduced form result from simulated data. Another, that monetary policy became more effective. So I'm happy to talk more and would appreciate your feedback. Thank you so much.